Ajay Srivastava joins us now. Ajay, good morning. Thank you for joining us. So Ajay, how's it looking? Are we in for choppy, nervous days ahead of US presidential elections?
I think we are going to be, and I think that's the important part for India at least, because Nikunj, not only that it's an economic impact of what's going to happen, but the China impact, because it's very clear now that if Trump loses elections, would that unleash the dragon onto the borders of India, which have strategic repercussions for us, because he's holding him back, China, at this point of time. So I think for India, US elections is more than economic impact; it's a huge strategic impact, because whether the Biden team will do what they're doing with China and hold them back compared to what Trump did. I think that's a key question for Indian markets going to be, and it's going to be a very important question because it overlaps everything, just oversees everything, economic, financial, socially, everything. If China decides to move, it's going to be trouble for the market. If no, if Trump is back, I think it's a great news for the market as far as India is concerned. So I think it's very binary. If Trump loses, we got a problem. If Trump wins, I think we are good for go for at least until February when the December quarter results start to roll in.
Why do you think this is a binary outcome? I remember last time when the US presidential election happened, it was the reverse. That if Mrs. Clinton wins, it's good news for the market. If Trump comes, it's bad news for the market. The day US President Donald Trump got elected, markets came down, and then we've seen the best patch for the US market. I'm sure that Democrats are also cognizant of what the economy needs, and nobody will do a self-goal.
Oh, no, absolutely. I think, Nikunj, I'm not saying that. I think their 2 trillion stimulus plan, they're holding up so that if they win, they're going to bring it in, and that's going to give a boost to the market like all the other stimulus plans have done. So have no doubt that I'm not sure Democrats, I'm sure, will do what they required, and they're holding back the stimulus plan only for the election to say, what's the point of giving the benefit to President Trump? Might as well bring it up when we are in power, and therefore we have the. So US, that's why I said US may still see a bump up because of the stimulus plan, which may roll off once the tax increases start to roll in. So US could still be seeing a steady kind of a flow there, but people are going to take critical calls. And whatever we are seeing, lots of market is being hedged at this point of time. So it's very clear that there's a stimulus plus in the US market, and to the extent that whatever happens after that might have a dampener on the equity market. But as I said, for India, it's more strategic. It's not about a 2 trillion stimulus driving the US market. And you may see a divergence between India and US at that point of time. The US may still hold on and go on because the China factor is going to be the key for Indian markets. We've seen the demand, we've seen the stimulus, we've seen the festival rush, and everything is looking okay, so to say, except the fact that government is now battling a issue of disparity of income. It's all over the place, India versus Bangladesh, etc., etc. So Indian government has got a challenge, and the last thing they want is a huge expenditure on defense and instability at the borders. I think that's what I said. To me, that's a more critical factor. Rest are by and large we have factored in and saying slow demand will come up, it'll move up, festival season looks okay, market is fairly priced, in most cases fairly priced. You don't need to go and invest big time in this market. Calm down, relax with your money, and let's see how the market rolls. So that's why I said only one strategic factor can change the nature of this market.
So what are you planning to do? I mean, how are you planning your portfolio for an binary event? If the verdict is something what market wants, markets will not fall or they will rally. If the verdict is something markets don't like, then markets will fall and there will be a portfolio damage. So as a fund manager, what are you doing? Are you buying protection, which is puts? Are you sitting on cash? What's the best strategy when you're pitted against a binary event for a portfolio investor?
See, so 2 ways. One is the US portfolio should be kind of hedged at this point of time because the hedges are not expensive, so you can hedge them. In India, hedges are pretty expensive, so you can't really hedge your portfolio. So you really need to be back where you were originally. You were back with the ITs, you're back with the pharma. You don't need to tweak the India portfolio. Okay, we lost out one big bet. We did not invest too much in autos, but that's all right. You don't need to go invest it now. So nothing needs to be tweaked to the India portfolio because by and large, the banking, the same 4 companies are doing well. Consumer has kind of stabilized and it's kind of on a very stable platform. You don't need to buy much. You don't need to sell much. If you look at Nestle's, Unilever, etc., the world, they will run around at this levels for some time to come. So the way to do it is, I think US market, if you invested, is hedge it. In Indian market, you just focus on export sectors, which you've done well for the time being and so on. because what will happen down the line if something goes wrong is the Indian consumption, Indian expenditure might get diverted. I think that's where the bottom line comes in for the economy per se. Therefore, nothing much to tweak on the portfolio, but certainly you don't want to be. And I think that's the important part. In the bottom 800 to 1,000 BSE companies, I think you don't want to be there because whenever anything happens, those are going to take the worst hit. So if you're in any of the 1,000 companies on BSE, at the bottom end of the BSE, I think then you got to be a very, very, very gutsy speculator, not an investor there. So clean up your portfolio. They're nice companies, decent valuations. It's okay. Don't keep it there. Nothing to be done.
Fair enough. Ajay, I mean, we've seen pharma and IT emerge as pretty much the leading trends. When it comes to IT in particular, even pharma, how much of your weightage and the portfolio weightage would you give to some of these vis-a-vis, let's say, the financials? I'm just trying to understand whether one is increasing the exposure, particularly to IT going forward, given the kind of performance we've seen, the kind of commentary we've seen.
See, IT, Abhay, the best thing to do for IT for the retired people is to buy IT stocks. They give phenomenal dividends. Absolutely, payout is very good. For one in 3 years, there'll be a buyback. So therefore, them, if you ask me, if you want to plan for retirement, you buy IT and hold, because these companies, there are 4 companies, you don't have much to worry about in terms of risk, governance risk, which is now coming up, as you saw in UPL, what happened, the collapse of the share price. So you are safeguarded. And number 2 is you get good quality inflows of funds. You look at TCS, the kind of money given back to the parent. So therefore, you don't need to dilute IT. And IT is a very good cash investment. I would not say buy in futures, because futures is a different item altogether. But for whoever buying in cash, buy and hold. I think that's important. Pharma, I think we just seen the first leg. The big one is still to come. Pharma will re-rate itself again in the next 6 months' time. Phenomenal interest globally in pharma companies, phenomenal PE funds flowing in. You will see lots of deal flows being announced. Crazy valuation, absolutely crazy valuation. But well, that's what it is. You got deal flows coming out of the US, money is pouring into the sector. So you dare not sell this sector. And if you don't have it, buy now. If you buy, have it, double your investment. I think that's the bottom line for pharma.
Okay. And as you mentioned, given that we're expecting perhaps moderate returns on the index, let's say by the end of the fiscal or over the next year, if we take a look at that and if you agree with that, is there scope to see multifold returns, whether it be in the broader markets, in select names, or should the aim be to really find steady returns at this point of time?
I think in this market, Abha, it's not only returns, it's the risk which is starting to play in as well. Because at this level of the index and the state of the economy, you got to start factoring in the risk as well. Return comes too at this point of time. That's why I said, factor in the risk first, that can you take the risk? Can you get a UPL in a stock? Look at what happened to Airtel. I have no clue what happened to the stock, but it's been a disaster, absolutely. So if you have got 2 good stocks and 1 Airtel, 1 UPL, that can wipe out your return. So the way to do this is to see that what is the risk appetite you carry and the shares that you classify as risk appetite. Because UPL is a leverage candidate, he acquires too much. So you need to be very careful when you pick up a UPL kind of stock. Airtel has surprised most everybody. But then you go to the IT company, then you go to the critical pharma company. You maybe even go to Nestle and find it expensive. But the fact is that the risk you run of governance risk is very low. Risk you run of a default is very low at this point of time. So as the bank, and look at the banks, again, back to the point, 3 banks in India, that's it. Who is the 4th bank? Maybe SBI is struggling to join the bandwagon, but rest everybody decimated absolutely. Even HDFC Bank result yesterday. It was all other income which took the burden on keeping the results going, and I'm sure it's a nice favor away a gift for Aditya Puri to have the highest reporting profit, but it was not the operating income. It was other income which kind of saved the day for HDFC Bank. So you need to be carefully positioned, and I'm very sincerely positioned in that larger caps, the top names. That is where you want to sit with at this part of the index. Surely you may lose out some returns, but that is worth taking the risk out of a portfolio at this point.
Okay. Ajay, what's the view when it comes to the PSU space? Just a short while ago, we had some exclusive news coming in that the government has asked PSUs to either go in for a buyback of shares or spend on their capex. And we understand that the likes of Coal India, NMDC, NTPC, IL, etc., they're going to consider their buybacks fairly soon. Are you on the fence, or is it a sector that you'd be very selective in when it comes to PSUs?
I'm not. I have been a sufferer. I have not on the fence. I've been a sufferer of holding PSU stock. If you look at this market for the last 5 years, it's the worst performing sector of the stock market by a margin at this point of time. I have shown myself, and I keep telling every investor, everyone listens to me, I will not buy PSU again. I will not invest in the PSU stock again, because it doesn't matter. You can have a NALCO at a 0.4 book value. The stock is at 30 rupees, struggling away. The government could not sell BPCL in the best boom market of the year. You've seen every company struggling, Power Grid, PEC, REC. I would say there is no absolute reason to buy these shares at all. And therefore, because they have not performed, they will not perform. And it's very unlikely that you're going to get a big money out of the system by some sale of strategic sale. So my simple advice is, it doesn't matter to me what is the book to ratio at this point. Doesn't matter. The P's are in low single digits, whether it is PSU banks, PSU industrial companies, anything. Do not touch it with a barge pole. Is not going to give you the return, alpha return that you're looking for. They look very cheap, and they're cheap for a reason, that they don't perform.
Ajay, while pharma has definitely been ahead of the curve, there's been a lot of focus from investors on the API plays as well, particularly some of these mid and small cap names. Are you too jumping on the bandwagon? Are you seeing opportunity and favor within these API specialty chemical plays?
See, let's distinguish API and specialty chemicals. Two separate parts of the business, two separate altogether. Pure API companies are not even worth a dime. And let me be honest about it. People who are jumping on saying this is a pharma story are sadly mistaken. A pure generic API companies are only worth so much. They will remain in single multiples. They're not on the P radar of anybody. They are no acquisition value for most people. So therefore, if you're buying a pure API company which is focused on generics, I think you're asking for trouble. That's not the play. Again, I said, they're cheap, and they're cheap for a reason. The reason is simple. They do basic products. Number two is the fact that anybody else can do it. There are multiple suppliers of product. The price keeps going down year on year, and therefore you're in a bad sector of the market. But if you are into an API which is linked to NCEs, which is a new chemical entities, yeah, sure, you are in a big game out there. You look at DVs, he's a big player out there. But those are far and few. Most Indian API companies are in generics. Please do not waste your money. You will find, yeah, sure, some of the investors will come, it will go up and go down. But as a sector, APIs will not perform. Specialty chemical is a different animal altogether, which is purely because it's difficult to make, and the supply chains are relying on single or two suppliers. Therefore, you have a short supply and cost pass through. That's the important part of specialty, that you can pass through the cost, unlike API generics, which you can't pass through the cost. Therefore, when you look at specialty chemicals, sure, you can buy it, you can hold it, they will do well. But as I said, API generics is no-go at this point of time, and they are cheap, and as I said, they're cheap for a reason.
Ajay, you said you don't want to buy PSU stocks, but I distinctly remember a couple of weeks ago, maybe a couple of months ago, we had a conversation that how you're buying into stocks which are below the intrinsic value and offer a great dividend yield. So have you exited that position? I think it was PFC, NALCO, some other metal stocks also.
No, I have not exited them, but I have not added them. But given their underperformance and what we are going through with them, I do not think I'll buy a PSU stock again in my life. I'm holding them. I'll hold them, they'll give dividend, they'll give buyback some point of time. There is no point of getting out of it given what we have holdings. But we have cleaned out, for instance, we are out of, say, OMCs. We don't have any OMCs left. We have some metal companies left, and that's all about it. We are out of Power Grid, little bit is left, GAIL, little bit is left, but quite a bit has been shaved off. But what we have, we will hold and see how it pans out. But whether I want to allocate more capital, the answer is a capital NO. I will not do it. And it's been a design. Absolutely. What do I say?
It's not been a good experience. I completely understand that. Okay, let's talk about State Bank of India, Ajay. And sometimes there is evidence which we tend to ignore. The UNO platform is something which in a sense has become one of the largest digital platforms in India. If I compare Paytm and Uno is on course to break even next year. Paytm, we all know the fat losses they are likely to report. For State Bank of India, their credit card business is making money. Their insurance business is making money. The AMC is the biggest in India. How long do you think State Bank of India will suffer because of being a PSU bank? I mean, ultimately, banking is an experience, and if the customer does not like it, you can go to some other bank. This is not PSU, or this is not a metal or a OMC company where you have no choice excepting going to HPCL, BPCL, or IOC petrol station.
I hold State Bank. One of the holdings I have is State Bank in PSU. But, again, the point is, when I talk to people, you go out in the evenings, now it, of course, much less, you don't go out at all. But you go out and says, who do you bank with? I can't find people who bank with State Bank. It's a wonderful bank for industries because they lend a lot of money to industries. So that's a good part. They've done a good job with lending to industries, no doubt about it. They do lend to a lot of consumers somewhere in the system because their numbers show the number of customers. Like you said, Ono, etc., have done a wonderful job in terms of reaching out to a large mass of customers. But the value of State Bank is a sale value, Ono. It's not that PSU managers will run it. The point is, how do you expect to compete in a space for intellectual capital when you pay 1/100th of what the markets would pay people who manage these companies? At the end of the day, it's all about, as you said correctly, customer experience. How many of us deal with nationalized banks anymore? How many of us want to deal with the nationalized banks anymore? So no matter how good the thing looks, and it's wonderful, SBI Life Insurance, SBI Mutual Fund, cheapest stock, breakdown value of SBI is some 40,000 crores, which is dirt cheap. Everything, as I said, works in the favor. What doesn't work is who owns the bank. Back to the same point. Governance is the issue. UPL is a good company, but the problem of auditors got it down. Cafe Coffee Day was a good franchise, wonderful franchise. Look what the promoter did to the company. So it's not about the company. It's also about who owns it, governance. Tomorrow they want to do a social lending platform. Who better than SBI to go and lend? And they have done it in the past, and they continue to do that in the past. So when, to me, State Bank is a government entity out there trying to masquerade as a bank. Although it's a government department, they do funding for various social schemes. I'm not saying it's not required, but that's their mandate. Therefore, as a pure commercial decision to invest, you're not investing in a company which is commercially run 100%. You're investing in a company which is shown to be commercially run, but for a social objective and extension of the government. Now, do you want to be there? That's a call. It's not performed so far for this reason. I doubt it will perform. As I started by saying, the pressure is going to mount on the government for social equality. The Bangladesh controversy is not going to go away in a hurry. There's going to be West Bengal election right around the corner. So when you go that path, how do you put the money in the hands of the people? State Bank of India. So therefore, there you go. So there are good parts and bad parts. Take a pick that whether governance will prevail or fundamentals of ONO and insurance will prevail.
Okay, Ajay, appreciate your time and thank you for joining us. Gagan Banga now joins us. Let's connect with him to understand what is the way forward for India Housing Finance, the fact that they've sold portion of their stake in Oak North Holdings.